Hi, everybody. My name is Adeo Ressi. I'm CEO of the Dessel Group, and I'm going to be talking with you today about how to be a limited partner. And let me tell you a little bit about how I've come to be in a position to talk to you about that. So I've really been on all sides of the table for about half of my career. I really was working as an entrepreneur. I was very fortunate to have two separate billion-dollar companies by the time I was 30, back when $1 billion was a lot of money and not chump change as it would seem today. And then, after that, kind of pivoted my career and really focused more on the investing side. Launched a very big accelerator that operated in about 300 cities around the world, created something called the Safe Note. And then I moved even further and launched the Decile Group, which has launched roughly 60% of all new venture capital firms and funds worldwide. And as part of that, we have a fund of funds. So I began investing as a limited partner myself. And we launched something called the LP Institute, which trains new limited partners or existing limited partners on how to master the craft. And so I've just being on all sides of the table, I've gained a lot of knowledge about venture investing and investing in venture that I'm going to share many tidbits with you today. So again, if you have questions, pop them in the Q&A, or you can also put them in the chat. I'll try and monitor them both, and you can interrupt me with a question. I might even ask you as we're going through for some stuff, and I'll try and work them into the presentation. But I do have a presentation, so let me get started. How to be a limited partner. Really 4 steps to find great investments in venture capital. And maybe just to get started, um, it's historically and presently, venture capital has been the top performing asset class to invest in. And like all things that you can invest in, there's segments of venture capital. So not all segments of venture capital are the best investment asset class, but there's segments of venture capital that outperform every other asset class. And we'll be covering what those are and how to invest in them today. And the opportunity to get the best returns really requires that you follow a process. It's not that complicated of a process, and I'll be covering it today. It has 4 steps, and I think everyone here is more than capable of mastering it. And on top of just getting great returns, everybody, it's exciting, right? You feel like you're participating in the future, and I'll cover a lot of that as well. But first and foremost, let's discuss what is venture capital. Because we launch, as I mentioned, about 60% of all new venture capital firms and funds worldwide. And the reality is that even venture capitalists themselves are not always clear on what venture capital is. So I'm going to give everyone here a really simple definition. And there are people who are saying, because it's kind of a fad to be a venture capitalist, like, oh, I have a venture capital firm and fund. And when you really talk to them, it's not a venture capital firm and fund, it's something else. And so, probably the easiest way to think about this is that when you're a venture capital firm and fund, you are making investments that are very high risk, but they can also be very high reward. So I'll give you an example of both the high risk and the high reward to give you a sense of what I'm talking about. And I'll go full screen for this because it's kind of important. So high risk means that the normal venture capital portfolio will see a 70% failure rate. So if you see someone coming to you and they're like, oh, I'm going to have 80% of my portfolio get to a 1 and 20% of my portfolio get to like a 5, that sounds more like PE, where they're trying to get most of their portfolio to return the money and a little extra, and then they're going to have some wins, and it's a much more conservative style of investing. PE stands for private equity, whereas venture capital is really, by comparison, the wild west of investing, where 70% of the investments that a venture capitalist will do or more go to zero. And so it can be very challenging as a limited partner to see, oh man, this other company died or this one didn't work out. That's what happens, right? Because it's a high risk, high reward. So let's talk about what the rewards are. So I have a bunch of news from just the last week. One of our portfolio funds has a company that's getting a 56x right now. So if you put in $1 million into that company, you would walk away with $56 million today because of it. That's what the 56x multiple stands for. Now we have another one that's at a 45x. Now, and ironically, these are what are called the quick exit. So the 56x, I think, is only 2 years old. So the firm came in and 2 years ago, and 2 years later, it's worth 56 times whatever the firm invested in the first place. Again, if they put in 1 million, it would be 56 million. Now, many of you are like, wow, that's amazing. But actually, that's okay. That's what I would call a basic fund returner. So when you start getting in the 50 range, one single investment can return your entire fund because you normally do 20, 30, maybe 40 investments in a fund. On top of that, you have some fees. So once you start getting to the 50x range, that one deal can return the entire fund and maybe even return it more than once, so maybe two times. But again, that's a relatively conservative outcome for venture capital firms. In fact, there's a saying in venture capital, the lemons ripen first, which means that these early exits, they look great on paper, but they're lemons. They're not the really, really big winners. The really, really big winners that venture capitalists play for are returning 1,000x, sometimes even 20,000x. Okay. And when you start getting 1,000xers, then you can get really big returns, obviously, on the entire uh, fund and firm with just one deal. And in fact, it's often a few deals that return the entire industry, not just the entire firm and fund. They can be so big that you can look at periods of time and say it's this one deal like eBay or Google or Meta, etc., that return for venture capital funds a massive amount of money and really help the entire industry. So just going back to the presentation, what that's called is the power law. All right. And in there is something called the power law. It's also called the Pareto distribution. It is the basis of all venture capital investing, and it's the idea. It's actually discovered by an Italian gentleman named Pareto, and he was a farmer, and he noticed that he was growing beans, and certain plants would return 20% of the plants returned 80% of the harvest. So it's this 80-20 concept. That's been extrapolated further into the power law. And the concept of a power law when investing is that you could have one single portfolio company in, let's say, a venture capital portfolio, and it will return more money than all of the other companies in that portfolio combined. And you see this time and time again with venture capital funds, that there'll be one company that returns more than all of the other companies combined. There's a famous story by a friend of mine who invested in Ron Conway's fund that went into Google. And the fund did okay. It wasn't particularly good. It probably would have lost a little bit of money, except Google, and Google gave it this, multiple dozens of time return from a single company. It was bigger than all of the other companies in the portfolio combined by a massive amount. And so venture investing is a power law game. And you want to be looking for the the firms and then that can find these power law type companies. And then once you're in the firm and fund, you want to be looking at the portfolio and saying, which one of these can be a power law? They'll have escape velocity, lots of demand, media attention, etc. In addition to that, when you're investing in venture capital, as I brought up before, there are segments of the venture capital asset class. Some segments perform better, some segments perform worse. What are called established funds, funds working on fund four, five, six, the big players, right? Sequoia, Andreessen, Lightspeed, they are later, bigger, and they tend to get less returns. You might see really good performance from those type of firms and funds at a 3 to 5x. That would be fantastic. 2x would be really, really good. And then, maybe 1.5x would be the median. The way venture capital returns work is there's something called the top quartile and the top decile. The difference can be fairly staggering, like 1.5x for median, 2.5x for top quartile, and maybe a 3.5x for top decile. And this is in the established firms with bigger funds, investing later stage, etc. The best returns in venture capital, though, are smaller funds working in earlier stage that are called emerging managers. They're newer. So smaller, earlier, newer make much bigger returns. Great example of this, the number one returning fund of all time was a fund won by a gentleman named Chris Sacca, lowercase capital. It had, there's a lot of estimates out there, but somewhere between a 230 and 260 X return. So again, if you put $1 million in Chris Sacca's fund, you would walk away with 260 or 230, depending on which stat you look at, $1 million as a return. So smaller, earlier, and newer funds perform much better. Just to give you a rough sense of what that looks like, these smaller, earlier, newer funds, the median may be around 2x. The top quartile could be 3 to 4x, and the top decile could be 6 to 10x. So it's multiple orders of magnitude bigger than their established counterparts in terms of the returns that you can receive. So we talked a little bit about venture capital. Let's talk about the process of finding and investing in great funds, right? Because that's why we're here. So how do you do it? Where do you look? And really the first thing to begin with is what do you want, right? Because you could get funds all day long, African funds, South American funds, Canadian funds, European funds. There are funds everywhere in the world focusing on all different kinds of things. So obviously, and all different stages, late stage, early stage, big funds, small funds. So let's assume for a moment that most people here want to make the best possible returns. You may not have unlimited amounts of money to invest, so you're probably going to go to smaller, earlier, newer funds because you can put less money to work and you're going to get better returns, right? So let's just start there. Let's make that assumption. But even with smaller, earlier, newer, are they in the US or LATAM? Are they focused on AI or healthcare? So there's a lot of other things that you need to decide what you're interested in. I have a framework here that you can use. So if you want to screenshot this or take a picture, it's also published online. Maybe we could put a link in the chat. But it's like you intend to allocate X amount of money, $1 million, $100,000, whatever, over the next year to invest in early stage funds in the US, targeting AI, prioritizing vertical applications. And I'm going to dedicate, 10 hours a week to explore 10 possible funds to invest in. So this gives you just like how much are you investing over what time frame in what stage type of funds, like are they early stage, late stage, seed stage, etc., where in the world, right? And what sectors are you interested in? And the sectors, let me tell you talk a little bit about some things that you should think about with each of these. So money and time frame, that's all you. I can't help you there. Stage, geography, sectors, and additional criteria, I can help you with. So you pretty much want to go early stage. There's angel stage, pre-seed stage, seed stage. Those are the three early stages. There's also accelerators and venture studios. Okay. But angel, pre-seed, and seed are where most of the funds that you might look at will focus. If you want to get the best returns, that's where you got to go. It might take you 10 years to get the maximum amount of returns out of the fund, maybe 15 years to get all the money back. But you should be in the money on early stage fund that's performing well within 5 to 7 years. Our I hope we have a fund of funds, and I'm hoping to return over a 1x within 4 years on a fund of funds. So it's doable to get your money back within a few years and then start getting upside within 5 to 7 years, and then start really getting the big returns in 7 to 10 years, and then you're harvesting some of these later stage that are longer duration returns in the 10 plus year. So you want to go early stage, in my humble opinion. But of course, later stage means lower returns in less time. But earlier stage means greater returns in slightly longer time, but it's not that long in the whole scheme of things. Geography's tricky, right? Many people here might have operations in Latam, and you want to support local companies, so you might want to go into a local fund that invests in local companies. Perfectly understandable. They're great returns in Latam right now. They're great returns in Africa right now. They're they're pretty much great returns everywhere. Obviously, the United States has the best returns, but it's also the most crowded market. So it's easier to find a winning company in Central Asia than it is to find a winning company in San Francisco. Because in Central Asia, there aren't that many companies. If you have a fund, it's most likely going to see the winning company. Whereas in San Francisco, there's winning companies around every corner. And there's also a lot more companies and a lot more funds. So it's just more difficult to find the real winners. But if you get a manager that does pick some winners, obviously the returns here in the Bay Area in the United States are the best in the world. So geography is very personal, right? Are you in a region? Do you want to support that region? Do you want to swing for the fences and go for a big market like the United States? You have to make that decision on your own. And similarly with the target sectors and geographies, obviously AI is very hot right now. We're seeing big returns in AI. Our AI funds are all doing very, very well. You know, the AI wave is, you know, there's something called the Gartner hype cycle, and we're definitely in the upswing. So are we at the top? Probably not, but we're not at the bottom. So we're somewhere between the bottom and the top. And that can also be a kind of tricky time to invest. Crypto is doing very well right now. Crypto, we're seeing some of the best returns in our crypto funds. Climate is doing very well right now. We're seeing some great climate funds with great returns. So, here's what I would say about the sectors. So, you want to look at sectors that have the opportunity for great returns, but you also want to look at sectors that you care about, right? So, if you don't really care about crypto, don't invest in crypto funds just for the returns. If you think crypto is really interesting and you think it's going to be a big opportunity and you enjoy learning about it and spending time on it, pick that sector and go after it. Now, I see there's a question in the chat like why smaller emerging funds do better. Um, Listen, the there's a lot of reasons, so I'll try and unpack this quickly for you, and then I'll go into additional criteria and continue with the presentation. So, first of all, when you have a big fund, like $1 billion fund, it's very hard to take $1 billion, invest it, and turn it into $10 billion because then you need the companies that you invest in to be worth 50 billion or 100 billion dollars because you have, let's say, a 10 or 20% stake if you're lucky. And so in order to take your $1 billion fund and get it to get a 10x, you need companies that get many, many billions of dollars or $100 billion of valuation. They're just not that many. You can literally count the number of companies in the 50 to $100 billion range on two hands worldwide that are private. And they're more now than ever before. So these big funds really have to get very lucky and get into the handful of these really, really big winners in order to get the returns that the smaller funds enjoy. Conversely, if you have a $10 million fund, turning that into $100 million is very easy. There's a lot of unicorns. There's thousands of unicorns worldwide. One single unicorn can get you that return. And there are thousands of unicorns worldwide. So again, turning 10 to 100 is much easier than turning 1 billion, 10 million to 100 million is a lot easier than turning 1 billion to 10 billion. So you just see that these smaller fund sizes, and this is a known thing in the venture capital industry. Everybody knows if you have a smaller fund size, you get bigger returns. And the emerging managers, these are people who are launching fund one, fund two, fund three. They're hungrier, right? They have to prove themselves. If their funds don't work, they're dead. So they've got the one shot to prove that they're going to make it, and they work really hard to do so. So back to prioritizing additional criteria on this. So beyond stage, geography, and sectors, you may want to go after ethical managers, or you may want to fund women managers, or you may be interested in funding managers that have a certain worldview. And that's really, again, these are very personal things. Like, what do you care about, and what do you want your managers to care about, so that you guys are aligned? And venture capitalists, despite all the hoopla and everything else, are money managers, right? They're You don't have enough time to review hundreds or thousands of startups to pick the best AI companies, or pick the best healthcare companies, or pick the best climate companies. So you find a manager who does that for you. They are your money manager. And you want to find a manager that you like. You want to find a manager you believe in. And I'm going to be talking about that next. So let me jump into that now. So the four steps to investing in VC are sourcing, finding the managers, selection, identifying the managers that you want to potentially invest in. Diligence, making sure you understand what their fund is doing, that the manager is actually going to do what they say and say what they do. And then closing, getting into the fund. There's a whole other side, which is once you're in the fund, but once you're in the fund, that's fairly easy. I'm going to be covering these four steps quickly today. We got another question coming in. Do larger venture funds also operate in internal pre-seed investment teams, or do they mostly rely on emerging managers for that exposure, and why? So it really depends. You see a lot of different things happen in the market today. Most of the very, very big funds, the Light Speeds, the Andreessen Horowitz, etc., they do seed and pre-seed investing, and it's like buying an option. So they'll come in, and I don't think this is great for the industry, by the way. So an Andreessen or a Lightspeed or any one of them will come in and they'll write lots and lots and lots of seed or sometimes pre-seed investments, and they're essentially buying a seat at the table so that if that company ends up taking off, it's almost like placing chips on the roulette table, then they can put more money to work on that company. Because what happens in venture capital is like it's just like roulette. Like the ball spins, da, 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 lands on something, and you want your chips to be on that number. And you want the most chips possible on that number. So in order the difference between roulette and venture investing is you kind of you get a hint that it's going to be this number, let's say 32. Um, you're like, whoa, I think it's going to be 32. And you have the option to put more money down. Now, once it's becoming clearer and clearer and clearer that the winner is going to be 32, right? Everybody wants to put money on that number, right? And so if you already have a little bit of money on that number, if you already have an investment in it, you're more likely to be able to put more money than another VC firm that's trying to get in later. So there's very sharp elbows in venture capital because they don't want other people to come into the hot deals. Now, of course, Lightspeed doesn't want Andreessen in the deal, and Andreessen doesn't want Lightspeed in the deal. But there's an exception to that rule, and that Lightspeed and Andreessen are okay having smaller funds in because they're not threatening. And that's why the smaller, earlier funds can get in to these winning companies without being squeezed out by the larger firms because they're just not threatening. And a lot of times they add value. Um, okay, so let's go through the four steps of investing into a venture capital fund. So, sourcing, selection, diligence, and closing. So, we'll cover them one by one. Sourcing. This is really finding a bunch of people to potentially invest in and then making a decision to invest in one. I would say, um, look, if you're a professional limited partner, you may look at hundreds of firms and funds before you invest in one. You could easily look at 100 to 1, right? I would say up to even 1,000 to 1, right? That's the spread. For most people here, you don't have that time, you don't have that luxury. So you're going to be looking at somewhere around 5 funds and firms to 10 funds and firms to invest in one. So you'll source 5 to 10 and invest in one. And there's a lot of ways to do this. We have a whole platform. We have a matching platform. We feature about 30 funds every couple months, every 2 to 3 months. We refresh it. We add new firms and funds. and they're in all different sectors and geographies. So you can see there's like, you can filter by location, stage, experience level, etc. And so you can narrow it down at any one time. There are easily 5 to 10 firms in different stages and sectors that you might be interested in that you can diligence. It's so happy to share more information about that if people are interested. We also do speed matching events where in 1 hour you do 8 minute meetings with managers, and you can enter some criteria, and we'll try and match managers. You know, there's a little bit of a round robin effect, but we'll try and match managers so you can get 5+ meetings in 1 hour for managers that you're interested in. So we do a lot of things to make sourcing easier. So the best thing that you can do for sourcing is to, especially if you're not going to do this professionally, where you're looking at 100 to 1,000 per investment, and you're more in a 5 to 10 per investment ratio, you want to go to places that have vetted managers that you know are good before you even meet with them. So you're not kicking the tires on 1,000 people to get to one. You're kicking the tires on 5 to 10 to get to one, and you are sure that the 5 to 10 you're going to meet some quality standards. So we have that as an offering. We make it relatively easy. Again, we do matching events, and maybe you could put a link in the chat to the next matching event. We do um, a matching marketplace, etc. So that helps with sourcing. And that's probably the best way for most people here to do sourcing. Come up with what you want to look for and then use a proven system to go there. Let's talk next about, okay, you get these 5 to 10. How do you uh, how do you select them? There's a question coming in about fund of funds, and yeah, so let me discuss quickly fund of funds. So that's back on the sourcing bit. Uh, so look, like everything, right? So if you're investing in startups, you don't want to invest in just one startup. You want to invest in multiple startups. When you're investing in funds, you don't want to invest in just one fund. Ideally, you want to invest in multiple funds, because the more diversification you get, the more likely you're going to get some of your money on the number 32, the roulette spin that's going to be the winner. So if you're playing and investing in AI, you want to make sure that some of your money goes into the winning AI companies, because that one company can not only return the whole fund, it may make the returns for the whole industry of venture capital, all of AI, et cetera. Early investments in OpenAI right now are looking fantastic, uh, because the company is the most valuable private company ever, right? So you could have a 500 to 1,000x if you were an early OpenAI investor very easily, and it started at very high valuations. So you fund of funds allow you to leverage your money and get into multiple funds with a single investment, because the traditional fund and funds will invest in anywhere from 10 to 20 venture capital funds itself. So you put $1 in a fund of funds and you get that spread out among 10 to 20 different funds that the fund of funds invest in. So at a minimum, if you're not going to be investing in 5 to 10 funds yourself, you might want to invest in one or two funds plus a fund of funds as a strategy. All right, so how do you select? I'm going to go back not to fund of funds, but I'm going to go back to just you picking a normal fund. So how do you pick the fund? This is it's not as scientific as it would seem. With established managers on fund 6, 7, and 8, you can say, okay, tell me about funds 1 through 5, how did they do? And you can do a very good analytical and process to say, okay, given the performance of fund 1 through 5, I feel that fund 6 will perform like this. The manager says this. You can do a lot of this analytical work to determine the outcome. When you're dealing with new and emerging managers, there's just not a lot of data. So most of it is your gut. Okay. You kind of you listen to the manager, you hear what they have to say, you check that what they've done in the past, they've said what they're going to do, they've done what they've said they're going to do, and then on top of that, they tell you what they've done. So that's sort of the adage in venture capital. Tell them what you're going to do what you said you're going to do, and then tell everyone what you did, right? That's the how VC works. And so you want to validate that, make sure you like the manager, that you have a good relationship, and it's really a gut instinct that this manager is going to do what they say they're going to do based on your gut feel. Now you can do a little bit of analysis on their track record, and I'll talk about the diligence next. But the first level of selection, and let me give you an example. So you meet with 10 managers, and you're probably going to come away and say, hey, I really like 3 of these managers. I really feel that they can do what they say they're going to do. I have a good working relationship with them. They have an interesting track record. They have an interesting approach to the market. It really resonates with me. So I'm going to take 3 of these 10 into the next level. And I wish I could say it was so simple as to do some mathematical analysis or review something very specific that you can say, okay, this is a 5, that's a 4, that's a 3. But really, it's your instincts that this manager can do what they say they're going to do. And it will work something like 2 or 3 out of 10 will be someone that you want to proceed with into further diligence. I'll go into diligence in a second, but I want to bring this point up. So you need to meet with at least 5 to 10 in order to calibrate your gut to make sure that you're picking the best 3. If you only meet with 1 or 2 or 3, you'll never really know that they're better than 9 others or 8 or 7 others, right? So you have to meet with at least 10, preferably. We in the program say at least 5 because people are very busy, but really it's 10. If you're not meeting with 10 firms and funds, you're not going to be able to train your gut. You're not going to get a sense of what's happening in the market. You're not going to make good selections. So I would say plan to meet with at least 10 funds to select 2 or 3 to proceed to the diligence. So let's talk about diligence. Um, Diligence takes many forms. If you're an institutional limited partner and you're meeting 100 to 1,000 funds, and you still may only go and diligence 10 and meet with a lot. But so diligence takes many forms, and with institutional diligence, you might do 20 or more reference calls, right? But for most people here, your diligence is going to be a lot simpler, and I'll give you the things that really matter. There's maybe too much to discuss, but I'll cover it pretty quickly. You want to get access to their data room. Every fund has a data room with various pieces of information on deals they've looked at, their track record, their biography, written references, legal documents, etc. So in order to do diligence on a firm, you want access to their data room. In order to get, you can say, hey, I'd like access to your data room. The manager will take that as a buy signal, right? You're interested in investing. but they also are cautious because there's very sensitive information in there. So they may ask you to sign a non-binding letter of intent. We have something called the pact. The pact is widely used. It's a non-binding letter of intent that just says, hey, I'm interested in investing this much money. So if you want access to a data room, you're probably going to need to sign a pact. And so, or some other non-binding letter of intent. So you sign the non-binding letter of intent, like a pact. They'll send you a link to the data room, at which point you're going to have information overload, right? So I'll tell you what you want to look at in the data room to do diligence. I'll tell you how to do it very quickly, and then we'll talk about the closing. So you're gonna have, and I'll go full screen for this. You're gonna have lots and lots of stuff in the data room, right? Legal docs, references, etc. The thing in no particular order. Obviously, you want to look at their presentation if you haven't seen it already. Just thumb through it. Most presentations follow a certain flow. You want to really look at the things that make them different from every other fund. Every fund helps their founders. Every fund has some process to evaluate founders. So, what makes this particular fund and this particular manager different? You want to identify that in the presentation first and foremost. Next, then you want to look and validate what makes them different in other materials in the data room. So look at their bios, look at their references. If you say, hey, this manager is different because they have lots of connections in the AI world, well, that should be evident from their references, evident in their bio. This, and then you want to look, so that's the next one of the next places to look. In addition to that, they'll have written deal memos. They'll say, oh, we're looking at investing in a deal, or we've invested in this deal, and here's a deal memo that shows our thinking and our process to invest. So you want to validate that the deals they're doing or the deals they have done reflect the thinking and the differentiation that you've identified. Okay, so deal memos are very important. You also want to look at their legal agreements. You will not understand these legal agreements, so you want to put them in to something like a Chat GPT or a Claude or a Grok. I find Grok and Claude are a bit better for this, but any will do. And you want to ask questions about the legal documents, right? What are the economic terms? There's something called limited operations mode, which was what happens if a fund runs into trouble. How does a fund enter limited operations mode? How does a fund exit limited operations mode? You also want to ask about capital calls, which is when they require money for you. So what are the rules around capital calls? What happens if you miss a capital call? So take the agreement, load it into one of the LLMs and ask it questions. And that's a great way for you to do very good due diligence. So again, get into the data room, make sure you read the deck, check the bios and written references to validate the things, check the deal memo to validate your assumptions as well, and then load the agreement in and read it. And that's shorthand should get you most of this stuff. So after diligence, right, you're going to want to go and into the closing. And usually these are pretty turnkey in this day and age. So you'll be sent into some sort of closing system. You'll need to fill out some information, possibly an accredited investor form. Um, and then once you complete all of that, you'll be asked to do a capital call. Now, the cool thing about venture capital funds is that most have capital calls, not, and these capital calls say instead of investing, let's say I commit $100,000, you don't have to wire $100,000 right away. There might be a capital call for 25%, so you only have to wire 25,000. So the fund will call capital as it needs it, and so you can invest 100,000, but only have to put 25,000 to work right away. Some funds, like the start funds that we offer, do 100% capital call, but most are doing 25% or 10% at a time, something like that. And that allows you not to have to invest the entire amount that you commit right away. And they'll normally call capital over, call it 3 to 4 years. So if you commit $100,000, you will pay that over 3 to 4 years. You will not pay it all at once unless it's something like a start fund. So that's something good to know. But usually the closing process is pretty seamless. As I said, you fill out some forms, you sign, you get a capital call, you complete it, and then you're admitted into the fund as a limited partner. And you'll get updates regularly from the managers, usually quarterly. So let me talk about that for a second, and then I'll give you a little bit about the program and take any questions you have. So you'll usually get a monthly newsletter, a quarterly report, and there'll be an annual meeting. And a lot of the best limited partners say, hey, when you invest in a venture capital fund, you're really buying a newsletter because you're getting insights into the sector, stage, geography, and industries that this manager is investing in from a real expert because they're investing pretty regularly. So I strongly recommend you read the newsletter, you check out the quarterly reports, and you attend the annual meeting to get a lot of value along the way as this fund is building and generating returns. It will also start to give you a sense of what the breakout companies are that are going to define the success of the firm and fund. We have a program to take you all through this. I'll cover it very quickly. It's 2 months long. It's called the LP Institute. The first half of the program, we get you all the way into diligence, right? Orientation, overview, venture. So we covered a lot of this very shortly here. We cover it in more detail in the program. And then in the second half of the program, you're really picking the firms, doing the diligence, and actually investing. So we encourage everyone that comes in to the LP Institute not only to have meetings, but to come in with the intention of completing an investment. And you have some of the best people in the world doing office hours with you, weekly meetings, etc., to help you make a smart investment. So you get hands-on guidance to complete that investment every step of the way by top professionals who will answer all your questions, work with you on anything that comes up, etc. And so the goals of that program are you meet amazing peers that are investing just like you learn the investing skills, and you make some great returns along the way. At least those are the goals. It's got a very high net promoter score, 83. And actually, the final admissions deadline is on Monday, but we're going to extend it because we like to have like 50 to 100 LPs in it. We have, fund of funds, we have sovereign wealth funds, we have all the way to angel investors, and we group everyone. So if you're an angel investor, you'll be with other angel investors in high net worth individuals. If you're a family office, you'll be with other family offices. So we like to get 50 to 100 people in so that they all are in groups of like-minded people, and it's rated very highly. Hopefully this was helpful, and I will now take a moment to answer any questions that you have. Thank you very much for attending so far, and let's turn it over now to some questions. All right, so we have some questions in the Q&A. We have some questions. The Q&A is at the bottom of the screen. I have some questions that I've collected before, so maybe we'll thank you for saying that's great. I appreciate that. We have a question here. I believe the power law is directly proportional to the universal pain points facing humanity at the time. How can one spot startups with the power law? And well, look, that that's why you have professional money managers to find these power law startups. And a lot of times it's going to be luck, to be honest. But you, like all things with luck, right? You can just get lucky, make one single investment, and it turns out to be an open AI, right? Or you create a situation for luck to happen where you say, I think LLMs are going to be really big, so I'm going to make multiple investments in LLMs, and one of them will likely win, and therefore you might invest in Anthropic, OpenAI, X.AI, etc., and then one really, really wins and becomes the power law thing, and you make your own luck, right? So what a lot of these managers do is they make their own luck. They have a thesis that says, hey, I think this is going to be big, whatever it is. It might be something healthcare related, AI related, etc. They say, okay, so I'm going to put a lot of bets on the proverbial roulette table so that when one hits, I make sure I'm on that number. I'm on the 32. And so they make their own luck that way, right? And then one of the nice things about you being a limited partner, not only do you get on number 32 with your money because you're in the fund, so you can get a very big return as a result. So that happens. And also, right, you often have the ability because the manager will say, hey, dear LPs, we're in a winning company, OpenAI. OpenAI is raising more money. Would you like to directly invest in OpenAI? They may set up an SPV or something like that. So you will have co-investment and follow-on investment opportunities as an LP in these power law winners as a result of being in these funds. And that can be very game changing. Obviously, if you get in, for example, I got in a very early round of X.AI, the friends and family round. And right now, we're looking at somewhere like a 15x on that. Okay. And it's only been about a year and a half. So you can imagine. And what did I do? I invited the LPs to come into the X.AI round and said, hey, everybody, we got in this very interesting company. It's a friends and family round valuation. Would you be interested in coming in? And a bunch of them said yes. And so we all went in, and it's been a great opportunity. There's a question about, hey, are there funds or SPVs? So here's what I would say. SPVs are where you're betting on a single company, and funds are when you bet on multiple companies. As a general rule of thumb, my strategy as a limited partner would be to invest in funds, and when the funds have a winner, use an SPV to come into the winner, right? Right now, people are selling SPVs everywhere about all sorts of companies, and really, you don't have enough time in the day as a limited partner to do what a manager does. It's a demanding job. They've got to review a lot of companies, a lot of things, figure out which ones are best. So rely on the manager to find the best companies. And when they say this is the big winner, then consider making an SPV investment. I would make some exceptions to that statement with saying things like, if you're really passionate about AI and you get an opportunity to invest in an AI company at a fair valuation without excessive fees, then maybe you do an SPV. So you can do an SPV here and there that's not connected with your fund investment because you're passionate about a sector or company. But otherwise, I would stay to fund investing and use SPVs selectively there. I want to see if there's some other questions here. I'm seeing some funds doing pre-seed, seed, deep tech, but some of them are only like 5 million. I like them a lot, but 5 million is not a lot of money to do even 20 investments. Um, don't worry about fund size, okay? Most of the information on the internet about venture capital is wrong, okay? And I'll tell you what, I'll reiterate what I brought up in the beginning. Smaller, earlier, newer funds are better. Smaller, earlier, newer funds are better. This is actually a truism proven with tons of data over many years. So 5 million is not a bad thing. Remember also what I said. These big funds have sharp elbows. So a big fund doesn't want another big fund in their hot company. But they let small funds in because the small funds are not threatening. So small is actually a winning strategy for many funds because they can get into these big power law deals without threatening other big investors that may not want them in. So I would not look at a small fund size as a bad thing. In most cases, a small fund size is a good thing. This was amazing. Thank you so much for your time, everyone. We do have to wrap. Hopefully, we covered a lot of bases and made this journey of investing in venture capital funds more enlightened and knowledgeable for you all. I loved it, and I hope to see you in one of our programs. Thank you. Bye, everyone.